Hello, welcome to this Ned Davis Research Vodcast, where we will help you see the signals. My name is Brian Sanborn, NDR's Global Head of Investment Solutions. In this episode, we'll be speaking with NDR's Chief Economist, Alejandra Grindal, about Japan. Alejandra, in early August, it was rough, especially for Japan. Following the Bank of Japan's rate hike, the Nikkei 225 index dropped more than 12% in one day. Based on the aftermath of this monetary policy shift, do you think the BOJ will continue to tighten policy?
Yeah, that's a great question, Brian. And a lot of clients have asked us the same thing. And in our view, while we think the Bank of Japan will continue to cautiously move forward, we don't think it's done tightening policy. Now, of course, this is with the caveat that there's no hard landing in the US economy, which for now is our base case scenario. But there are a number of reasons why we don't expect the Bank of Japan to reverse course and to keep on going forward. So one is the firming of second round inflation effects, and this is for the first time in decades. Also, if you look at the calculation of the Taylor rule, it's kind of an equation that takes into account inflation and GDP growth, kind of sort of tells you what a central bank rate should be. It argues that the rate is still way too low in Japan. Also, according to purchasing power parity, the yen is still hugely undervalued. From an equity market perspective, if there is some volatility in the Japanese market, households really don't own a great deal of equities. They actually tend to hold more in bank accounts. And then the carry trade, which impacted a lot of investors, there's not a huge amount of evidence that Japanese were, quite that involved in the carry trade. It's just not quite as pronounced if you look at the data. And then, one of the final reasons is it's just sort of a now or never opportunity to do this.
So let's get into more detail. Why did the BOJ choose to start tightening policy at the beginning of August?
So I think it's important to sort of step back and think about the fact that the Bank of Japan has been implementing unconventional monetary policy for decades. And they really haven't seen that many results from it. There's little to show for it. And except for a failed rate hike cycle in 2006, interest rates have been roughly around zero since the early 2000s. So before the financial crisis, global financial crisis, quantitative easing was actually just Japan's thing. It was unique to them. And from their perspective, the opportunity to normalize policy, use conventional means of monetary policy in the future kind of seems like a now or never opportunity. Especially when you look at the Bank of Japan's target rate, it's been negative on a real basis for longer than any other time in recent history, and compared to being positive in other parts of the G7. And then I talked about before the Taylor rule. It suggests that the Bank of Japan policy rate should be almost 300 basis points higher than it is right now. So running monetary policy, of course, has its risks when you run it counter to the rest of the world. So we know you could see a jump in the yen. We could see maybe less impact on inflation, could provide some downside risk to corporate profits, even the stock market. But the Bank of Japan recently said, it would maybe refrain from rate hikes during unstable market environments.
So Japan had little to no inflation for decades. What changed?
So really it was supply shocks. First associated with the pandemic. We saw that here in the United States. We saw it in other parts of the world. Russia's invasion of Ukraine also created other supply shocks from an energy perspective in some commodities. And then that rapid weakening of the yen. So the result of these supply shocks brought Japan the longest period of sustained inflation in decades. So if you look at the headline core CPI, so their headline core is just excluding fresh food, it's been at or above the Bank of Japan's 2% target for 28 months. And this is actually the longest winning streak or positive streak since 1992. It was a long time ago. Now, as I said, the supply cost inflation that Japan has experienced, it's not really the best kind of inflation. It's not the preferred kind. But the hope is if it lasts for a while, which it indeed has, it gets embedded in inflation expectations and in wages. And then that ultimately creates a positive feedback loop. And, following a couple good years of successful wage negotiations and record high inflation expectations, we are starting to see signs that this premise is bearing fruit.
So based on everything you've discussed in this episode, how far do you think the BOJ will raise rates?
Well, and that's a good question too. Probably not as high as what the Taylor rule would suggest. And I would say one of the main reasons is Japan still has pretty low growth potential. This is its best possible GDP given its inputs. So doesn't leave a whole lot of room for the Bank of Japan to raise rates. I suspect by the end of 2025, so the end of next year, we could see the Bank of Japan's target rate at around 1%. Anything measurable beyond that would require a sustained pickup in Japan's potential growth. And at this point, we see that as highly unlikely.
Alejandra, thank you for your insights. NDR clients can read Alejandra's research notes in her weekly global economic focus publication. The indicators Alejandra and the research team developed for our own subscription service are also used in our model portfolios, which are available for direct delivery on TAMPs and as ETFs. For more information on NDR, we encourage you to visit ndr.com. Also, for those listening in audio-only mode, video versions, including charts of See the Signals, are available by going to info.ndr.com/ndr-signals. Thank you for joining us as we help you to see the signals. So long.